probably heard you need to get pre-approved before buying a home. But what does that actually mean and how does it work? In this video, I'll break down what a mortgage pre-approval is, why it matters, and what lenders are looking for when they approve you. A pre-approval is a lender's written estimate of how much you can borrow based on your income, credit, assets, and debt. It's not a guarantee, just an estimate. There are a few key factors that determine your eligibility, and I'll talk more about those later on. The pre-approval gives you an idea of your estimated loan amount and shows sellers that you're a serious buyer. Just remember to also have your own budget in mind because you probably don't want to spend the full amount you're pre-approved for. Think of it this way. Based on what they see, lenders are saying, we're confident you can afford this much, but it's not final until underwriting is complete. A lot can change between pre-approval and closing, so it's important to be prepared. Pre-approvals are usually free. Lenders want your business, but it's still smart to check whether a lender charges an application or credit report fee. Now, what's the difference between a pre-approval and a pre-qualification? A pre-qualification is a quick estimate based on self-reported information and usually doesn't include a credit check or full documentation. Because of that, a pre-qualification is less reliable. A pre-approval, on the other hand, involves a full review of your credit, income, and debts. You'll send in documentation, and that makes the pre-approval carry a lot more weight with sellers. To put it simply, a pre-qualification is a general idea of whether you might qualify, while a pre-approval gives you a much clearer and more trustworthy picture. And a little note here, if you're going on websites like Rocket Mortgage and other online lenders, a lot of times what they're giving you first is a pre-qualification and not a pre-approval. So that's one of the reasons that real estate agents in general don't like those sort of services, because the client will get a pre-qualification and they'll think, oh yeah, this is what I can afford. But once they actually start to go through everything, it turns out that's not exactly what they can afford. So what are lenders actually looking for? They're mainly evaluating four things: your credit, debt to income ratio or DTI, income stability, and available assets. Let's start with credit. They'll be looking at your FICO score, which can be different from what you can see on Credit Karma or similar sites. Sometimes your bank or credit card provider shows you your actual FICO score. Most loan programs require at least a 620 credit score, but higher scores usually come with better interest rates. For USDA loans, a 640 or higher score typically qualifies for automated approval, though technically USDA doesn't have a hard minimum. FHA loans allow for a 580 score if you're putting 3.5% down, or 500 to 579 if you're putting 10% down. The best interest rates usually go to people with scores of 740 and above. If your credit score is under 620, you may still qualify for a USDA or FHA loan with manual underwriting, but your lender options will be more limited and your interest rate may be higher. The next thing lenders look at is your debt to income ratio. This is your monthly debt divided by your gross income. Most lenders want your DTI to be under 45%, but some loan programs go higher. For example, FHA might allow a DTI up to 57%, though that's rare and not something I recommend. A high DTI can make it harder to manage monthly payments. Next is your employment and income. You'll typically need 1 to 2 years of consistent income with a W-2 job, self-employment, or another verifiable source. If your income isn't quite enough, you might consider applying with a cosigner, though not every loan program allows that. I don't usually recommend using a cosigner unless it's truly necessary. Lenders will also look at your assets, especially your bank statements. They want to confirm you have enough saved for your down payment and closing costs. But don't worry if you're not fully there yet. There are ways to work around that. For example, you could apply for a zero down loan like USDA, use down payment assistance, or ask the seller for credits to help cover closing costs. As far as paperwork, here's what you'll likely need: pay stubs from the past 30 days, W-2s or tax returns from the last 2 years, bank statements for at least 2 months, and your ID and social security number. The more prepared you are with documentation, the smoother the process will go. You can also head to my website at workwithdang.com for free resources, including a quick start guide and a full homebuyer course. I can help connect you with a real estate agent in your area. Just check the website for more info. I make content like this every week. Please subscribe if you haven't already. Now let's walk through the actual steps of getting pre-approved. First, you'll want to shop around for a lender. Talk to at least 3 lenders and compare interest rates, loan programs, and fees. Each lender is a little different, and some are better suited for specific types of loans. For example, if you're considering a USDA loan, you'll want someone who's experienced with that program. Once you've chosen a few lenders to talk to, you'll submit your application. Most lenders have online portals, and the whole process of entering your information and uploading documents usually takes 10 to 15 minutes. After that, the lender will pull your credit. This is a hard inquiry most of the time, but it typically only lowers your score by a few points. If you apply with multiple lenders around the same time, those credit pulls might only count as one inquiry. It's a good idea to double check how this works before applying. Credit rules can change over time. After the credit check, the lender will review all of your information. If everything looks good, they'll issue you a pre-approval letter. That letter is usually valid for 60 to 90 days. If it expires before you find a home, you can send in updated info and the lender will renew it. The letter will show your maximum loan amount and might include an estimated interest rate. Having the letter before house hunting helps you move quickly when you find the right home. So what does the letter actually mean? It tells you how much you can borrow, not necessarily how much you should spend. Let's say you're pre-approved for $400,000. That doesn't mean you need to spend all of it. Once you consider your comfort with monthly payments, savings goals, or daycare costs, your true budget might be more like $350,000. That's why it's important to treat the pre-approval amount as a ceiling, not a goal. In many markets, sellers won't even consider your offer unless you're pre-approved. It shows them that you're serious and have already been vetted by a lender. One thing to watch out for is how the lender estimates your property taxes and homeowners insurance. In my area, those costs can vary a lot by neighborhood. If they underestimate those expenses, your monthly payment might be higher than expected, and that could lower how much home you can actually afford. So make sure to ask your lender about those estimates. Let's also go over some common mistakes to avoid. First, don't assume pre-approval is a guarantee. Final approval only happens after underwriting. Also, don't change jobs or take on new debt during the process. That includes car loans or putting furniture on a credit card. It can raise your DTI and cause issues. Don't make large deposits without documentation either. Those can be red flags for underwriters. The best thing you can do is be prepared and be honest with your lender. Have your documents ready before you apply. Avoid opening or closing credit accounts during the process. And again, be upfront about everything. Even small omissions can delay or derail your loan. If you have a more complex financial situation like being self-employed or having multiple income sources, make sure you're working with a lender who understands that. And don't ask just what you're qualified for, ask for an estimate of your monthly payment, including taxes and insurance. If you're thinking about buying a home in the next few months, getting pre-approved is your first step. Now that you understand how mortgage pre-approvals work, the next step is knowing how the full home buying process goes. Check out my video, How to Buy a Home in 2025. I walk you through what to expect from start to finish. Please like, comment, and subscribe if this video helped you. It means a lot and keeps me making more content like this.